Hi guys. So it's 6 p.m. on Wednesday evening, 24th of May, and I'm doing this recording for you guys, which is a walkthrough of the answers to your second assignment. So hopefully you are listening to this and sitting there with your assignment in front of you, your marked assignment, so that you can have a look and see where you went wrong and what sort of format the answers should have been in. And this is going to be really helpful for your exam revision. So I hope you take the time to listen through to the end and look at the workings for these questions. Okay, so I'm going to start so that the recording isn't too long. I'm just going to, actually, let me not use this. I'm going to share the screen. Where am I? And then go through the, I don't want to share files. I'm going to share my screen and then go through the assignment document on my laptop with you. That will be easier than trying to page through it in Blackboard. Okay, just hold on a second. We'll see our little kaleidoscope in a minute. There we go. Okay, so I'm going to go to the assignment document. So I'll go up to the beginning just to quickly review the questions again, so that if anybody who doesn't have their assignment document with them can just be reminded. But it is also a good idea if you have your assignment document with you, questions and that, so that you can follow along. Hold the questions, keep the question paper in your hand when we have a look at the answers. Excuse me. Okay, so question number 1 was only for 10 marks. It was the 2 5-mark questions. And all we had to do here was, for each of the following statements, indicate the word that best describes the statement, and you had to come up with the word or words that describes the statement. So this you would have found in your textbooks if you had looked carefully. So we'll have a look at that, at the answers in a second. And then the second part of question 1 was, for each of the statements below, indicate if the statement is true or false. So again, sorry, I'm just having a look at my paper. Okay, all right, so that was what question 1 consisted of. So I'm going to go down to the memo so we could take a quick look at that one. All right, so here's the first part of the question, 1.1, with a statement. So here they've ordered everything correctly. So here are our 5 statements. The first one, the method of depreciation, where the annual depreciation is calculated as a percentage of the carrying value of the asset. So take note that the depreciation is calculated as a percentage of the carrying value of the asset, as opposed to a percentage of the cost of the asset. So when we do this, it's called the diminishing balance or the reducing balance method. Okay, so those are the 2 methods of depreciation that you guys do this year. In a question, they'll say the percentage of depreciation is 20% per annum or 30% per annum or whatever it is. And then they'll say 20% per annum on a straight line basis, where you take the percentage of cost, or they'll say 30% on diminishing balance method, where you will then take the percentage as a value of the carrying value of the asset. Then the second one, assets that are controlled by the entity for longer than 1 year. So all we wanted there, that those are called non-current assets. Then the accounting concept that stipulates that all expenses must be assigned to the financial period in which they were incurred. So this is expenses, to make sure that we record all expenses for the month of January against January's income. Or in most of the cases that you guys do, you're looking at a whole financial year, that all of the expenses that pertain to one specific financial year are recorded against that financial year's income. So this is the accrual concept, and it's one of the most important accounting concepts that we apply in the real world. So you'll often get questions on accrual because it is very important. Make sure you revise this, and also how to do these workings, which in the same paper where you had to do the statement of profit or loss, you had to apply this accrual method. Then the fourth one, the source document used to record depreciation in the general journal. So take note, they wanted to know the name of the source document. Okay, so our source document for all entries in the general journal are journal vouchers. So the journal voucher is an internal document that we record in number sequential order. So each time we want to record a general journal entry, we fill out a journal voucher detailing all the information, and then using the journal voucher as the source document, we then enter the journal entry into the general journal. Then the last one, the document that shows the important details pertaining to a particular asset. The word document might have been a little bit misleading there. It's normally, I would have said, a set of records maybe, and this is the asset register. So we keep a register which records all of the details about all of our non-current assets. Every single non-current asset that we own, who we bought it from, what we paid for it, what its depreciation method is, all of that information is kept in the asset register. All right, then the second part of the question, this was the true or false one. Liabilities are resources controlled by the entity for less than a year as a result of a past event from which future economic benefits are expected or likely to flow into the entity. So obviously there they've really muddled a lot of different things together, and that is false. A liability can't be a resource. An asset is a resource controlled by the entity. But that even wouldn't be true because assets are controlled by the entity for more than a year, etc. So this is really a bit of a nonsense sentence. So that's definitely false. Then the second one is the account, in other words, the general ledger account name that is credited when recording the depreciation journal entry every year is called the accumulated depreciation account. And that is true. And just remember, with accumulated depreciation accounts in practice, and if you have to do that in a question, we always write it as accumulated depreciation vehicles, accumulated depreciation furniture, accumulated depreciation equipment. So in other words, we have an accumulated depreciation account in our general ledger for each category of asset that we have got in our books. Okay, that's important. And opposed to that, the account that we use for depreciation, that is the depreciation expense account, there's only one of those, and its name is always just depreciation, and it's an expense account. And all of the depreciation, whether it's expense for vehicles, computers, equipment, plant and machinery, all goes to the same, debited to the expense account called depreciation, and the credit goes to accumulated depreciation vehicles, accumulated depreciation equipment, etc. Okay, so make sure you know that journal entry very well for recording depreciation and how it works. Remember also that the accumulated depreciation account is the account that we call a negative asset, because the accumulated depreciation accounts are always married to their relevant or matching asset account. So we have got an asset account called vehicles, which contains the rand value of vehicles at cost, and then married to that account will be accumulated depreciation vehicles, which will have a credit balance. So my vehicles asset account married with the accumulated depreciation vehicles account, those two debit vehicles, credit accumulated depreciation, the net amount is then the carrying value of vehicles. So that's why we refer to accumulated depreciation accounts as negative assets. Then accrued expenses can be classified as a non-current liability. And that is false because they would not be non-current, because non-current would mean they would only be paid in longer than the next 12 months. Accrued expenses is a current liability because an expense is always something that you have incurred right now in this current month for your operations. So accrued expenses would be classified as a current liability. Then prepaid expenses occur when expenses have been paid in the current financial period, but the actual expense will only be incurred in the next financial period. And that is true. So sometimes we do prepay. So in other words, you can particularly say, for instance, with rent or insurance, this often happens. So we might pay in the month of December, we actually make the payment for January's rent or for January's insurance. So we can't record that as a December expense because we might have paid the cash amount. The cash transaction took place in December, but the expense is only going to be incurred in January. So that is why we call it a prepaid expense. And we also then do a journal entry to credit the expense account in December and debit the prepaid expense account in the balance sheet, which we will then hold over to release in the actual month of January. Then the account to be debited when recording the creation of allowance for credit losses is debtors control. So when we are creating an allowance for credit losses, we have to debit the actual credit losses expense account. Debit the expense account and credit the allowance for credit loss account, which is a balance sheet account. Okay, so these look like quite simple questions, but you can learn a lot by these types of questions and understanding exactly what these different sentences mean. And they're super important because these are all the principles that you have to master in order to do well in accounting. Okay, so now let's go and have a look at question 2. Okay, I just quickly want to pop back to the other screen to check if anybody has logged in there. No, okay. All right, so just give me 1 second. All right, so this is a question for 45 marks. The following are some of the balances in the books of Concord Limited as at the 30th of June 2021. So that is their year-end date, 30th of June. So the balances that they've given us are all balances regarding their fixed assets or non-current assets, as we call them. So they have got equipment, vehicles, and furniture. So these are our non-current assets, and assets increase on the debit side. So this is why we record the value. The value of our assets at cost is what is recorded in these accounts, and they will always be debits because assets increase on the debit side. Then, as I said, these 3 accounts, the accumulated depreciation accounts, are the negative asset accounts. So they will always be credits, and equipment at cost minus accumulated depreciation equipment is how we calculate the carrying value of equipment. Okay, so we've got that for equipment, vehicles, and furniture. Then we've got some additional information. As regards equipment, an office computer was purchased on the 1st of October 21. So remember the figures that they have given us were as at the 30th of June 2021. So these transactions that they have given us are for transactions that happened during the year ending 30th of June 2022. So these balances are the opening balances for the year 30th of June 2021. So on the first day of the financial year, these were the opening balances. 1 October, we bought a new computer for 20,000. Then a vehicle with a carrying value of 60,000. So take note, the carrying value meaning asset minus accumulated depreciation value of 60,000, and accumulated depreciation of 91,400 was sold on credit. So in other words, we didn't sell it for cash. We sold it on account to a Mr. or Mrs. G. Gundolf for 55,000 on the 1st of July 2021. And then non-current assets are depreciated as follows. Equipment, 33.33% per annum on cost. So that means the straight line method. And then vehicles and furniture, both on the diminishing balance method. So just take a look at this second one here about the vehicle. So they've given us the carrying value of the vehicle, and they've given us the accumulated depreciation. They didn't give us the cost value, but as long as we've got two of the variables or amounts, we can always work out the third one. So because we know that asset at cost minus accumulated depreciation equals carrying value, if we've got carrying value and accumulated depreciation, we can take carrying value plus depreciation, and that will give us the cost of the vehicle that was sold. So just simple little calculations like that you must be prepared for, and make sure that you understand what these amounts mean so that you can do those calculations with by working out what they've given you. So what they wanted then for 15 marks was to prepare the asset disposal account to reflect the sale of the vehicle. So quite simply, all we wanted then was, remember, general ledger. The general ledger means the T account that is named asset disposal. So you must complete that to show what the entries would appear in the asset disposal account for the sale of the vehicle. And then for 30 marks, prepare the note to the financial statement that shows the movements for property, plant and equipment. So basically the property, plant and equipment note for the year ended 30th of June 2022. This note to the financial statements, particularly for PPE, is very important. They always ask this. It's one of the very important exercises in accounting that you do in real life all the time, and it includes all of these calculations regarding disposal of assets, purchase of new assets, depreciation of assets, revaluation of assets. So you will always get asked for these notes because it tests us on everything to do with our non-current assets that we record in property, plant and equipment. Okay, so let's go and have a look at the memo, the asset disposal account for the disposal of the vehicle, and then the PPE note for our equipment, vehicles and furniture. All right, so I want you to just take a look at these marking notes that we have got at the top here. So when we mark this, we have got the instruction that in order to, in other words, how are we allowed to award the marks to the students? So to get the marks allocated to the details and the folio, so here's our details column, here's our folio column, details, folio. The detail and the folio must be on the correct side of the ledger account. In other words, you must have got the debit side or the credit side correct for that particular part of the journal entry. And then to get the mark allocated to the amount doesn't have to be on the correct side of the ledger account, but the actual value has to be correct. So if you have a look at the marks, there's 1 mark allocated to the detail, half a mark allocated to the folio, and then 1 mark allocated to the amount. So you can only be awarded this 1.5 marks if your entry was on the correct side of the of the T account. Okay. So remember, we call this a T account because we've got date, details, folio, amount on the left-hand side, which is our debit side. And then we've got date, details, folio, amount on the right-hand side, which is the credit side. So this creates a T, okay, T formation with the name of the general ledger account at the top. So asset disposal, your debits and credits and the entries that go in here are always going to be exactly the same. There are, in your textbook, you've got, I think it's the 4 or 5 steps to asset disposal that they've got in your textbook, and they are always identical. So we always go and look for the cost of the item that was sold. We credit the actual asset account and we debit the asset disposal account with the cost. So they told us, let me just double check here. So in the question, they gave us the carrying value and the accumulated depreciation. So we had to add those two together to calculate the cost of the vehicle. Where's our workings? Here we go. Cost plus accumulated depreciation equals the 151,400. And then we go and look for the accumulated depreciation value for that asset that was sold. And we debit the accumulated depreciation account and we transfer that credit into the asset disposal account. So what we're actually doing at an asset disposal is we are transferring the cost of the asset from the asset account into the asset disposal account, and we are transferring the accumulated depreciation value of that asset out of the accumulated depreciation account and into the asset disposal account. So the value of the asset is still a debit on the left-hand side and the ACDEP is still a credit on the right-hand side. And then once we've transferred the carrying value of the asset into the asset disposal account in that manner, we then record the sales price that we received for that asset. So in this case, because they aren't going to pay us cash straight away, we are selling the vehicle on credit, we will debit debtors control and credit asset disposal with the sales price. So we're selling the vehicle for 55 Rand. So credit asset disposal 55 Rand, and we will debit debtors control with an account for G Gundolf to show that G Gundolf still owes us that 55,000. If they had have paid cash for the vehicle, this account here would be bank. We would have debited bank when we put the 55,000 Rand into the bank and credited asset disposal. Then we have to balance the asset disposal account. So we add up on the left-hand side, we've got 151,400. And if we add 91,400 and 55, we've got 146,400. Both sides have to add up to the same amount. So the left-hand side is the larger value, which means that we need to add an extra 5,000 Rand to the right-hand side so that the right-hand side also adds up to 151,400. So that is how we calculate this amount here, the 5,000, which because it's going to be a credit, we need to debit the loss on sale of asset and credit asset disposal. If the right-hand side had have been larger than the left-hand side, we would then have had to debit the left-hand side, debit asset disposal, and we would then have credited profit on sale of asset. So it all just depends whether you've made a loss on sale of asset or a profit on sale of asset as to which side of the asset disposal account you have to put this balancing entry. So now after we've done that entry, the left-hand side is 151,400, the right-hand side is 151,400, and there is no balance to carry forward. So the asset disposal account is cleared off to zero, and this account is then closed until we need it the next time we sell an asset. This is also a very important process, and your 1, 2, 3, 4 steps and 4 journal entries that you need to know for the disposal of any asset, and then also that's T account, what entries go into the T account asset disposal to record that. All right, and then the last one is then the note for property, plant and equipment. So they should really have headed this properly for you guys, because it's important that you start learning right from first year that the note is an official part of the financial statements, and it should be headed note number 6, property, plant and equipment, or something to that effect. So always with your note for PPE, you have one column for each category of non-current asset that you own in your company. So here we have equipment, vehicles and furniture. So we have a column for each of them. Sometimes they ask for a total column. In this case, you did not have to produce the total column. Then these line descriptions down here on the left-hand side are also always the same. This is your fixed format for a property, plant and equipment note. We have at the top opening value for cost minus accumulated depreciation equals the carrying value. And then at the end, we've got the closing values. Closing cost, closing accumulated depreciation equaling our closing carrying value on the 30th of June 22. Okay, so this is your opening balances, giving us the carrying value of our assets. This in between are all the movements that took place in our values for our various assets, and then that will then give us our closing balances for our assets. So it's opening balances plus or minus the movements equals closing balances. Okay. So these opening balances were given to you. So all you had to do was fill them in, cost and ACDEP, and take note, you must always put brackets around any amounts that are credits. So 80 minus 24 gives us a carrying value of 56, etc. for vehicles and furniture. Then our movements, it was only equipment that we purchased, some new equipment, which was our computer that we purchased, and they told us that we purchased equipment with at 20,000 Rand cost. So we always on our line item here called additions at cost, that amount is always at cost. No vehicles were purchased and no furniture was purchased. Then underneath that, we always have a line for disposals at carrying value. Okay, so take note, additions are always at cost and disposals is always at carrying value. So for the disposal was our vehicle, and they told us in the question that it had a carrying value of 60,000. So because additions are being added to equipment, that's a positive. Disposals are being removed from vehicles, that has brackets around it. Was the only disposal, nothing for equipment and nothing for furniture. Then the most important thing that you had to do here was calculate the Rand value for the depreciation for each of those 3 categories. So there are workings for each of those 3. So we'll go down to have a look at what those workings were. Again, so just take your last look at what we're going to do. It's going to be opening values plus purchases minus disposals minus current year depreciation equals closing cost, closing accumulated depreciation, which will then give us a net carrying value at the end of the year. Okay, so just remember, in equipment, we purchased new equipment, and for vehicles, we sold a vehicle. Furniture, there was no additions or sales. So that's pertinent to the workings for our depreciation. So workings number 1, this is the workings for equipment. I'm just going to write the EQ. So the 80,000 was the opening cost value of equipment that we had on hand. We didn't sell any of it, so we had it for the entire year, and they told us that we depreciate equipment at 33.3% per annum on cost. So 80 times 33.33 equals the depreciation for the year on the equipment that we owned all the way through the year. Then the computer that we purchased only on the 1st of October, we didn't own it for the entire year, so we are still going to work out the 33.33% depreciation on that, but we only owned that equipment for 9 months of the year. So 20 times 33.3 will give us a full year's depreciation, and then multiplied by 9/12 will give us the 9 months depreciation. So then we add together the depreciation value for the equipment that we had for the entire year plus the depreciation for the new equipment, and that gives us our total depreciation for the year, 31,667, which was the amount that we then entered minus depreciation under the equipment column. Then the vehicles, this was where we sold a vehicle. So workings 2, this is for our vehicles. There we go. So vehicles and furniture were both depreciated according to the diminishing balance method, which means we've got to calculate the carrying value of vehicles and then multiply that by the 20% per annum. But now remember, we sold one of our vehicles. So we first calculate 560 cost opening at the beginning of the year minus the cost of the vehicle that we sold. That will give us then the cost of the vehicles that we owned for the entire year minus 192, which is the accumulated depreciation at the beginning of the year, minus 91,400, which was the ACDEP for the vehicle that we sold. So that will give us the ACDEP for only those vehicles that we owned for the whole year. So we've got then cost for the whole year minus ACDEP for the whole year, giving us carrying value for the vehicles that we owned for the entire year times 20%. Okay, that equals 61,600. Because we sold that vehicle on, what was the date that we sold the vehicle? The vehicle was sold on the 1st of July 2021, which was the very first day of the financial year. So we did, the vehicle that we sold, we did not own it for the entire 12 months of the year. So we removed it on day 1 of the financial year. So we only had the remaining vehicles to depreciate. And then workings 3 is our workings for furniture. So this is for furniture. Let's put an F there. And this is straightforward. We didn't buy or sell any furniture. So this is then just our opening cost minus our opening depreciation will give us our carrying value of furniture, which was the same carrying value that we had for the entire year, multiplied by 15%, because that's diminishing balance method as well. Okay, and then those are the 3 depreciation amounts we entered into our note for PPE. Okay, so hopefully all of these explanations are really helping you. I always try with these, when we go over these memos, to try and turn it into a revision session on these particular types of questions, because they are the types of questions that are commonly asked. Okay, just give them. All right, so then on to our last question, question 3. So again, let me just go back to the question. So this is quite a long question, so I'm not going to try and go through every single bit of the workings, because it'll be difficult to refer back to the question paper and the answer, but I will do my best to give you as much information as possible as to what the workings were to get the answers to each of the line items. Okay, so again, please make sure when you get to the exam you are reading every question super carefully. And I know it's really difficult. I can remember one's brain goes into a little bit of a panic mode, and it doesn't always work properly, tends to seize up on some things, but really try and slow yourself down and oh, okay. Sorry, I'm just looking at something on the question paper. I was wondering why I was confused. It says question 4.1, but it's actually question 3. All right, so pre-adjustment trial balance, and you are absolutely bound to get a question like this in the exam, where they give you a pre-adjustment trial balance. They'll give you a bunch of information as to what happened or what adjustments, year-end adjustments that you have to make, and then you will then have to prepare from that either a post-adjustment trial balance, or they'll ask for the statement of financial position, or as in the case of this question 3, they asked you for the statement of profit or loss. So pre-adjustment trial balance as at the 31st of December 2022. So that is this current year. Next to that, they gave us the closing balances as at the 31st of December for the previous year, because in some cases we needed to use that amount to then calculate what December 2022's closing balance was going to be. Like for instance here, with vehicles, we know what the opening balance for the 2022 year was, because they've given it to us here, and then we have to work out from the information provided what the closing balance for December 2022 was. Okay, so if you take a look over here, they've got capital loan, vehicles, equipment, inventory, debtors control, allowance for credit losses. So these accounts here, there are all our balance sheet accounts, statement of profit or loss. Okay, and then from here, sales, cost of sales, sundry expenses, rent income, salaries and wages, which is an expense, depreciation, which is an expense. So you see here we've got packaging material, which is a consumable, so that's an expense. Profit on sale of vehicle would be a type of income, and then credit losses is an expense, and drawings is an expense in that it reduces the owner's equity, so that's classified as an expense. So these accounts here are then all of our profit and loss accounts. So this is also something super important. You guys must be able to identify when given a trial balance. And if you have a look at this trial balance too, they haven't indicated whether these amounts are debits or whether they are credits. So you have to be able to identify by looking at the account name, is it a balance sheet account or is it a nominal ledger account? In other words, from the profit or loss, is it a balance sheet account or is it a profit or loss account? And then once you know that, you will then be able to decide whether the carrying value of that account is a debit balance or a credit balance. So for instance, we know that our vehicles and equipment and inventory and debtors control, all of those are assets, so they will all have a carrying debit balance. Allowance for credit losses is a liability, or it's also, should I say, a negative asset. It's the negative asset that belongs with debtors control, so that will always have a credit balance. A loan is a liability, so that will be a credit balance. Capital is owner's equity, which remember increases on the credit side. Remember your dead click. Absolutely crucial that you remember that. Capital is here on the click side, C for capital at the end. So capital increases on the credit side. Loan is a liability, so the L on the click side increases on the credit side. Vehicles, equipment are assets, so they increase on the debit side. Inventory, debtors control are current assets. Assets increase on the debit side. An allowance for credit losses is a negative asset that belongs with debtors control, so that will increase on the credit side. And then income and expenses. Expenses increase on the debit side and income increases on the credit side. All right. Then we've got additional information. The markup achieved is 160% on cost. The gross profit is 14,881,600. So if you have a look at this part of the TB, sales and cost of sales, they didn't give us either one of those two figures. The figure that they gave us was the gross profit. So how do we calculate gross profit? Sales minus cost of sales equals gross profit. So they have given us the answer to sales minus cost of sales, which is the 14,881,600. And then they've told us that the company uses a markup of 160% on cost, which remember we take back here, cost plus profit. In this case, I'm going to use the GP equals sales. They have told, so they've said markup on cost. So we've got cost is then going to be 100% plus a markup of 160%, which means that our sales will be 260% of cost. Okay, markup achieved is 160 on cost, so 160 on cost. So because it's going to be on cost, cost is 100. So 100 cost plus 160 markup means that sales is 260. They've given us this this GP amount, okay, the 160, and we then need to work out the sales amount and the cost of sales amount. So if 14,881,600 is 160, if we divide that by 160 and multiply by 260, that will give us the sales value. And if we take the GP and divide it by 160, and multiply it by 100, that will give us the cost of sales amount. And that's how you were to work out sales and cost of sales. So again, that means you have to understand these markup calculations. Packing materials used during the financial year was 39,700. So that means the actual cost of the packing materials that we consumed was 39,700. If we go to packaging material, you'll see here that the total amount of packaging materials that we purchased was 45,800. So this acts almost like a kind of like a prepaid type of situation. We can't expense all of that 45,800 to this particular year because we only used 39,700 of that 45,800. So we take 45,800 minus 39,700. And whatever the difference is, where's my calculator? Minus 39,700, it's 6,100. We would have credited the expense packaging material with that 6,100 and debited packing materials, consumables packing materials as an inventory account that would then go into the statement of financial position. So the amount that must appear here on our final trial balance for the year is 39,700. Then we have got here our debtors control, 382,000, an allowance for credit losses of 98. We also have got over here credit losses expense that we wrote off during the year of 28,800. We received 9,750 Rand, so cash was paid to us from the insolvent estate of a debtor who owed us money. But for each Rand that they owed us, we only received 65 cents. So that's what 65 cents in the Rand means. And the remaining amount, in other words, the 35 cents in every Rand that they owed us, that has to be written off, which means we've got to debit credit losses and credit debtors control with the 35 cents multiplied by the amount that they owed us. So the actual amount that we received was 9,750. So we take 9,750 divided by 65 cents. And that will tell us what the total amount is that they owed us. So they owed us 15,000 Rand, but for each one of those 15,000 Rands, we only received 65 cents. So 15,000 times 65 cents equals 9,750. So then 15,000 Rand minus 9,750, which is 5,250, is then the credit loss that we have to write off. Okay, and then that will be the additional credit loss. We must adjust the allowance for credit losses. In other words, the carrying balance of the allowance for credit losses must be equal to 9,350. So what we do there is we go and have a look at what the current, or in this case, current carrying value for credit losses is 9,800, and it must be 9,350. So again, your journal entry would be 98 minus 9,350. That would be the adjustment that you have to make. So what happens when we have to make an adjustment to the allowance for credit losses? We have to debit the expense account adjustment for credit losses with that difference. So in this case, our difference is 450. So that has to be an expense that we have to record here in the profit or loss side. Account name, adjustment for credit, adjustment for allowance for credit losses, 450 expense. One of the employees was on sick leave and was omitted. That just means we haven't yet recorded their pay because it was omitted from the salaries journal for December, and the salary payable to this employee was 38,500. So that is an accrued expense that we just have to add. So we go to our expense, salaries and wages, and we have to increase that by the 38,500 that we must still record, that isn't yet recorded. So our final carrying value for salaries and wages will be 6425 plus 38,500. Then the premises have been rented out for the past 5 years. So we as a company rent premises out to somebody else. So we have rent income, rent receivable for January 2023 has already been received and recorded. And the monthly rental has remained the same for the whole of last year. So that means if we go to our income account, rent income, this amount here, 221,000, is actually for 13 months worth of rent, because it's from January to December for this year, and we've already received the rent for January next year. So we've got prepaid, not prepaid, we've got rental income received in advance, which must come out of this. So if we take 221 divided by 13 months, we will calculate the value of 1 month's rental, and that's the amount that must be removed from this. Credit rent income and debit income received in advance. And we only want to record 12 months worth of rent. Then the loan from Wonder Bank, so that's our liability, that loan account that we've got. We have to provide for interest of 212,400 for the year. This entry has not yet been processed. So all that is then again is interest not yet recorded. So we must accrue the interest. So debit interest expense 212,400 and credit the interest accrued, which will be a liability account, current liability. An old delivery vehicle was sold for 88,400 cash. So 88,400 is what was received into our bank account. This has been correctly recorded. So that cash is recorded in our bank. So wherever where's our bank account? Capital loan, vehicles, interesting. Has been correctly recorded. Details of the vehicle sold. It had a cost price of 198 and accumulated depreciation on date of sale. So remember, cost minus accumulated depreciation will give us our carrying value. Um, 198 minus 115,500. The vehicle had a carrying value of 82,500. It was sold for 88,400. which means we sold it for more than its carrying value. Which means that we made a profit on sale of that vehicle of 5,900. The profit on sale. So in our income account here, profit on sale of vehicle, that is going to be that 5,900. And remember, that's going to be an income account, so it will be a credit. And then provide for depreciation. So we haven't yet recorded our depreciation for the current year. We've got our depreciation account here, but this 41,250 is only the depreciation on that vehicle that was sold. Because remember, when we sell an asset, we have to calculate the depreciation for the current year up until the date that it was sold, so that we record that depreciation so that we can calculate the profit on sale of the vehicle correctly. So depreciation on vehicles sold is 41,250. So depreciation, we have to add, so this is depreciation on the sold vehicle. Where was our depreciation? We have to add to that the current depreciation for the whole year for the vehicles and equipment that that we've got. Vehicles, we depreciate 25% on cost, and they have given us the rand value of the equipment depreciation. We didn't need to do any calculation for that amount at all. Okay. The question said, prepare the statement of profit or loss and other comprehensive income for December 2022. So you would have had to go and do all these work-ins that I've gone through with you here in order to work out what your balances were. Now remember, they only want statement of profit or loss, so not these accounts. That would be statement of financial position. We did not have to do those. We only wanted this section here. Okay. So let's go and have a look what our statement of profit or loss should have looked like. Work-ins, guys, work-ins, work-ins, work-ins. You must show your work-ins so that you get those marks. Please get into that habit if you aren't already. You have to be, you have to force yourself to be an absolute stickler, and anything, any calculation that you do on your calculator has to be written down on your paper. Okay, so I've already gone through all of these calculations with you. So I'm not going to do them again, but have a look at the format. Your format here, it's in your textbook. You have to memorize it. It is important. It has to be correct. Revenue. So remember, they gave us our GP. So revenue was 260 over 160. And cost of sales was our GP times 100 over 160. I've explained that above. Revenue minus cost of sales, that must be in brackets, equals the gross profit. So this was the amount that they gave us. And from that amount, and the fact that they told us our markup was 160 on cost, we could then work out the revenue and the cost of sales amount. Then always after gross profit, which is revenue minus cost of sales equals gross profit, the next section in our statement of P&L is other income. So then you must always go through and have a look at your TB. Okay, I'm not going all the way up there now. What other incomes did we earn? So here we had rent income, we had profit on the sale of the vehicle, and we had a credit of 450 to that allowance for credit loss adjustment for credit losses account. So because this credit loss adjustment account, if it's a debit, it would be recorded under expenses. And if we credit that account, we record it under income. Because remember, in the profit or loss account, if it's a credit, it's income. And if it's a debit, it's an expense. So our rent income here is where we had our total rent divided by 13. And times by 12, so 1 month's rent is 17,000. So we had to subtract 17,000 from the 221 to get 12 months worth of rent. Profit and sale of asset, I did that calculation above, and the allowance for credit loss adjustment, I did that calculation above. So we then take gross profit, we add our other income, gross profit plus other income now gives us gross income. And you see there's marks allocated for making sure that you are putting in these subtotals where they are supposed to be. We've then got a gross income. Okay, gross profit plus other income equals gross income. And then after that, we then record all of our expenses. So you can put your less operating expenses, that's what it's usually called. And then underneath that, you must list all the expenses. So they gave us sundry expenses, 88,000, that was given. Salaries and wages, we had 6425 on our TB, and we had to add that extra unrecorded salary that we still had to record to give us the new balance. Depreciation, this was the depreciation. This 41250 was what they gave us. The 90,500 was what they gave us as the equipment depreciation. And then you had to calculate the vehicle's depreciation, which was 25% on cost. So we've got opening cost minus the cost of the sold vehicle, giving us the cost of the remaining vehicles that we owned for the entire year times 25%. Because remember that 41,250 is the depreciation for the vehicle that we sold. So we have to take its cost out of this amount, otherwise we would be calculating the depreciation twice on that vehicle that we sold. So 41,250 on the vehicle that we sold, 90,500 for equipment, and 337,000 depreciation on the vehicles that we owned for the entire year. Then packaging material, they told us that 39,700 was the amount of the packaging that we actually consumed during the year. Credit losses, we had the 28,800, which was the opening balance that they gave us. And we had to calculate that additional amount of credit losses for that debtor that only paid us 65 cents out of each rand. I did that calculation with you above. So the total credit losses for the year. Take note also that these expenses, they've all got brackets around them, and all of the incomes are added with no brackets. Cost of sales has a bracket around it. That's very important. You have to indicate it, what is being added and what is being subtracted. Where were we? Credit losses. So after that, we then get net profit before finance costs. So that's another subtotal that must be there. Because again, in your format, if you look at the statement of profit or loss format in your textbooks, interest expense is always right at the very end, recorded separately. So we first do a subtotal for net profit before interest, then we record interest expense, and this amount they gave us. They said provide for interest of 212,400 for the year ending. That was the interest on our loan. And then that's always your last expense that you record, and then underneath that, your total comprehensive profit or loss for the year. Okay. So have a look at this, the way that this has been presented. You can see here on each, they've done the calculations, they've written revenue, and then next to that, they've shown what the calculation was that we did in order to arrive at the amount that we've recorded. It is easier from a marking point of view if you've got space on your paper to show your workings here like this. If you don't have space, or you would rather give yourself more space so that this isn't squashed, then do all of your workings. You would then, underneath, you would then have workings 1, and then whatever it was, and so on, workings 2, and whatever that was. And then where you've numbered your workings and shown the workings, you must, wherever you've used the answer to your workings 1, you must put next to that workings 1, next to where you've used workings 2, so that when I'm marking your work, I can see that you've written an amount down here, and I can see workings 1. I will go and look for your workings 1, and I'll be able to see exactly what your calculation was that you did in order to arrive at that amount. But please don't just put a bunch of workings all over your paper and not number them and not cross-reference them to where you've used them. And also, if you've got workings here, use a description where you'll say workings 1 revenue, so you can see this is my workings for revenue, this is my workings for cost of sales, or whatever it is. It's very, very difficult to follow if students just write the sea of numbers with no descriptions or references at all. Okay, so here again on this face, we've got all of the calculations that you had to do in order to get those amounts, and then the final amount after adjustments is then what is recorded in your final statement of profit or loss from your final trial balance. Okay, guys, so I really hope that this is going to help you with your exam revision. I'm sure it will if you take the time to sit and listen and make sure you've understood each of these calculations that I've described. It's really going to help you with your exams, because remember, your exams, you'll be sitting there without a textbook. It's a closed book exam. You have to have practiced this and be able to sit there and do it without looking at a textbook, and to be able to do it quickly, because your time is also limited to 3 hours to complete your paper. All right, guys, so I hope that's helped you to understand how you did in your second assignment, and that it's helped you with your exam revision. I'm going to go and finish off the recording, and then I will see you in our next collab, where we will also, well, I shouldn't say also do exam revision, although I'm really regarding this evening session as exam revision, where we will also, we'll continue with exam revision, and that will be on the 5th of June. All right, guys, thanks a lot, and I'll see you next time.